Hey, fellow acid capitalists. I'm back. Not only am I back, I'm back on my birthday. If I'm back, I have to answer, where have I been? I've been travelling. I finally completed. The bunker is no more. The bunker is now a gorgeous, beautiful St. Bart's villa. Maybe I'll be sharing images of it when I get the photographer's portfolio. But it's left me homeless, and I've been travelling. I've been in Hollywood. I've been in London. I'm staying at my favourite hotel in the world presently. Then I'm off to Paris. And then I think I'm going to go San Francisco, back to LA, and then possibly St. Bart's. But I've rested. And boy, when I travel, look what's happened to the world. So thank you for tuning back in. Sorry for the break in transmission. We'd love your feedback. We'd love you to, be on these global podcast platforms with Apple, with Spotify. You can give 5, 4, 3, just give a rating. Comments would be much appreciated. Give me a graphic idea. I want to do the I recommend you panic. IRUP. How do we make that bold and exciting? Join us on YouTube. Again, leave comments. Come on Twitter at Hendry_Hugh. I'm there. I'm supercharged, and I want to talk to you.
It's Thursday, the 16th of March. With me today, I have a great friend of the show, Hugh Hendry, on his birthday, no less. With so much going on this week, we're delighted to have Hugh in person in London. Hugh needs little introduction. A highly regarded ex-hedge fund manager, now St. Bart's luxury hotelier, investor, surfer, and of course, the acid capitalist. Hugh, welcome.
What a pleasure to be back, Nick.
Oh, it's lovely to have you back. Where do we start?
Well, there are many places we could start. I mean, I've been a vagabond I've been traveling for a month. I've not been on my precious island. I think I've probably got a few weeks still of moving around. We could discuss the dinner I had with just the hottest rock chick. I mean, she plays Jimi Hendrix style. I mean, Queen Kwong. She had the song Sad Man. I'm a sad man in LA. I'm fed up taking cocaine. People don't take cocaine. It's appalling. Anyway, we could talk about that. We could talk about Brad Pitt's Healer. He took me places. In fact, I'm listening to my Healer man, and I have to project with the heart and the chakra. I went in, he said, how much are you worth? I was like, get out of here. We don't talk about that stuff.
We don't talk about that stuff.
We were talking about ego and anti-ego, and how it ends up being a bit like the extremes of right and left-wing politics. They end up in the same spot.
Yeah.
They end up at totalitarianism. Kind of interesting. We could discuss that, but really, hey, it's my birthday. I was born in mid-March. And mid-March is one of those periods where money market, credit liquidity in the universe of finance. This is one of those rare periods in the year where it's modest. Mm-hmm. It's not abundant. And why is it not abundant? It's not abundant because we're coming up to the quarter end. And point to point, we take snapshots of banks and their balance sheet and their credit exposure. But of course, in between those points, if you were to see the VCR, you would really kind of see the heights. And they don't want you to see those heights. And so they are in abeyance. And the system therefore becomes vulnerable to what I'd call truth-seeking events. And we're in the midst of that. Obviously, it's been hit off by, you could almost call it the butterfly wings of this Silicon Valley bank.
So some chaos theory then?
A little bit. I mean, it's more than, it's clearly more than a butterfly. And I think I was alluding to, in one of my exchanges, we're in the heart of the city of London. There's a lot of classic scholars. And one of the terms out there is a nomen is a nomen, that the name of the messenger actually tells you more than the message itself sometimes. May I recall back in the height of the tech bubble, the NASDAQ bubble, at the end of the previous century. And there was a Swiss company called Miracle, a software company. And really it was a miracle that it floated. The name has resonance. And Silicon Valley and the resonance with regard to the connectivity to to private equity, to the venturists, I think is a more profound message, and we'll expand upon that.
And this, I guess, is 20 years of cheap money coming home to roost.
Well, this is the aftermath of the engagement, the reaction to the great financial crisis of 2008. So let's call it 15 years. I mean, obviously there was money before that, but let's date it from kind of March 2009.
Yeah.
Again, we are on the 15th anniversary thereabouts of the initiation of American quantitative easing.
Indeed. Now, during that great financial crisis, you famously said on Newsnight you recommend viewers to panic. Should investors be panicking now?
I panicked yesterday. And that took the form of selling. I have a self-select pension fund.
Yep.
And actually, I think I'm getting closer to being able to get my hands on it. You know, the George Osborne made changes. The Tory government made changes many years back, allowing you to get access to to your fund earlier. I'm getting closer to that point.
We won't comment, but we all know what age that would be.
Yeah, it's largely benign neglect, and I liked the convexivity of gold mining stocks, but I sold them all yesterday because I profited at the end from the roller coaster of 2008. And so one of the things that befalls an asset like gold is that smart people recognize that it has a very legitimate place in portfolios, and therefore it's the last thing they wish to jettison. Mm-hmm. And indeed is envied by others. And so it becomes a liquid asset. It's something that other people would be willing to purchase. But all that means is that when we get the purge and the intensity of the liquidity crisis, we haven't seen that yet. All we've seen in the past week has been an intensity to hedge a reassessment of the immediate future. We haven't seen the liquidity crisis. Perhaps we won't, but if we do, gold will be purged.
I mean, 2008, was that a solvency crisis rather than a liquidity crisis?
It was a collateral crisis. These are all collateral crises. Which of course is a domino, but it begins with a collateral crisis. I mean, 2008 was JP Morgan just refusing to accept the collateral and therefore demanding an unwind. Yeah.
Ironically, that it was JP Morgan that saved the market in 1907 with the solvency crisis.
Yeah, long time ago.
Indeed. But I guess, look, this is what happens when you raise rates by 500 basis points over a short number of months.
Well, I believe I've been vocal as to my horror with regard to the intent, the ambition, and indeed the realization of that tightening by the Federal Reserve, which has then kicked all the other central banks into copying and following suit. There'd been a lot of reference to the 1970s, to a decade of persistent inflation. What is inflation? Inflation is that the price increases in goods and services the previous year are maintained the following year, and with even more, and the following year with even more. And there's a speculation that we're back in that sort of environment. I reject that because, let's keep it simple, folk. Inflation is a monetary phenomenon, and there's not enough money. In fact, I see money contracting. You need money to be expanding in order to have the lubricant to support that additional 10, 15, 20% in terms of the money transaction to commit to the same level of goods and services. That's not happening. We know it's not happening because discretionary goods and services, people are cutting back on that. So 1970s references to Paul Volcker. So the Federal Reserve ultimately took rates to 20, overnight rates to 20%, the Fed funds rate. And my point was that back then, the 70s was what is the opposite of pinnacle? It was the destination, the trough of debt to GDP, and the pinnacle of a cultural demand that we deleverage in the aftermath of the bankruptcy of the financial system at the end of the 1920s. So we had 40 years. Cultural movements of that significance are slow. But by the 1970s, debt to GDP was, let's forget decimal points and round to the nearest. It was 1x GDP. So 1x times 20% Fed funds is 20. Fast forward 50 years to today, and 4x debt to GDP times 5% Fed funds rate. We're back to the heights, I would say the heights of absurdity. But things break. And this is why things are breaking.
Yeah.
Rates are punishingly high.
So what does Jay Powell do now? Is he painted himself into a corner?
Well, he did create this corner. He created this corner through the fibbing with regard to quantitative easing. In the midst of the pandemic in the summer of 2020, it was beholden upon him, and I get it, to allay the concerns of the household sector and indeed the wider economic community. But he found himself in the unusual position of presenting on daytime television. Mm-hmm. It's not really the purview of the Fed chairman. And he was pressed, and indeed he volunteered that the Fed were printing money. They were printing money in response to this extraordinary set of circumstances, and therefore they were underwriting what would be a subsequent economic recovery. But when pressed, are you printing money? And there was a valedictory tone to him. Yes, we are. That just wasn't true. However, it sticks. And having been the author and having been very insistent that he was printing money, he therefore took ownership of the higher prices. Now, the higher prices for goods and services are a result of an extraordinary supply-demand imbalance created by an extraordinary pandemic. Really nothing to do with...
which started in March.
Started in March. Indeed, ended with the profound mark-to-market painful period was essentially the kind of Monday of Tuesday of next week. It's the third weekend is when the liquidity systems is at its most kind of stretched. So Jay, having made that bold and I think fictitious claim, therefore took ownership of it. And so institutionally, the Fed, if you will, was, I think, sacrificing the economy on a cross of trying to restore its own credibility. And I find that awful, unforgivable.
So what do you think he does?
He raises rates.
So we continue to break things.
We break until you actually get the liquidity crisis. Yeah. All we're getting just now is that more of the financial community are actually coming around to recognizing what the inversion in government bond yield curves have been saying. They have not. Let me just say that they have not been predicting future Fed funds rates. They've simply, to my point, been saying we're effectively at 20% rates, and we will break. The financial plumbing is it's shuddering, if you will. Something's going to break, okay, and therefore we are hedging for. We don't know what the breakage will be, but we know the consequences of the breakage, and we are hedging. We're not predicting Fed funds. We're hedging the aftermath of the Fed's blindness or its conceit.
So SVB then was a canary in the coal mine?
Very much so. So the nomen as a nomen, I've spoken at large. I use this word conceit, the conceit and arrogance, that most of the travails, most of the pivot points, these extreme reversions and expectations come about because in the preceding months and years, there is the conceit and arrogance of well-formed arguments. Going into the great financial crisis, the conceit, but indeed the well-formed argument was that a geographically diversified portfolio of American mortgages was riskless because we had not the occasion, we had not the data set that would suggest that nationwide US house prices would fall. And that led to enormous risk-taking, because it was deemed to be, you weren't risk-taking until it was revealed you were risk-taking. So that was the conceit. The conceit this time around has been the willingness of significant economic agents, notably large institutional investors, and their mad scramble into the world of private equity. and the private equity houses themselves are colluding is one of those kind of funky words, but there's a consensus amongst them that they would.
Well, they've kept the status quo. They've kept the wheels spinning for themselves.
Yeah, they haven't marked to market in the aggressive manner that we saw in the markdown in the value of Facebook, Snap. I mean Netflix.
How wonderful to be able to mark your own homework when the market is falling out of bed.
Well, and what they say is, well, if we could do time travel and go back, what's the asset that you would buy? Yes, U.S. equities, but what's the generic asset that seems to do well independent of the sovereign domain? And that would be property, commercial property of all sorts. And what's unique about property? And it may be that, of course, in downturns, that the number of transactions is less and less, and therefore the strain or the clamour for mark to market is resisted, and therefore you can ride it out.
So I suppose there are fewer transactions to actually get a true price.
Yeah, and maybe that has facilitated or has allowed you to retain the investment. And so perhaps that's the argument that they've been having with private equity. That, hey, we know where it is, but let's not. Yeah. Where are all the customers' yachts? Let's not tell the customers. Yeah. Now, SVB,
and also there's a very marked amount of carry in those funds for the principals as well.
Well, I know where the principals' yachts are. They're in St. Bart's. But again, where are the customers' yachts? Indeed. And the Silicon Valley Bank was the community banker to that community. And they, startups is the final 3 to 6 months. You raise capital, you burn it. And then they step in and they fund you to the 3 to 6 months to the next fundraising. And in return, they get wealth management from the fabulous wealth being created. They get preferential placement in these amazing funds and asset allocators like Sequoia and others. And it's very virtuous. And what's been staggering has been how that community turned on them. Mm-hmm. That bank was nothing but kind of benevolent to that community, but it was facing it didn't have the comfort choice that the large institutional investors and the principals of those funds had, in that we won't see any fundraising in perhaps a decade, right?
Certainly within that sector. I mean,
it couldn't lend.
I mean, who's going to fund the 26th best dog walking app in Southern California now?
Mm. But imagine, I mean, there's this very famous psychological test. Forgive me, I can't remember. I'm sure we'll put it in the program notes, the authors of it. But it's called the Invisible Gorilla. And it captures us. It's a building like this, and you have the lifts coming up to the floor, 2 lifts, and you've got some kids kind of having an impromptu game of basketball amongst themselves. And you're asked to count how many the white top team, how many hoops they score, let's say. And so you're focusing intently on something. And at the same time, a guy in a gorilla suit comes out of the lift and walks through the game. And you don't see, a lot of people don't see it. SVB was a modest gorilla in the sense that they had reported their results. They had reported a mark-to-market loss of $15 to $16 billion, alongside equity of $15 to $16 billion. They were absolutely walking dead, but people chose not. And again, I can see they chose not to actually weigh or determine the significance of that.
And then it seemed to me that the risk department was a bit asleep at the wheel.
I mean, that's called a bull market. You make money and you can get away with all sorts of comedy. Yeah. Always the way.
So then what happens next for that subsector of the economy?
The banking, the secondary banking, or the banking?
More that sort of technology.
Technology? Well, it doesn't feel... I mean, we've briefly given credence to the NASDAQ bubble of the peak of 23 years ago. But it was a clarion call as to the revolution in our society. We didn't have iPhones when Nasdaq was at 5,000, but it was heralding that our life was going to change. 23 years in the future, our life will obviously be, I think, will be richer, will be more interesting. But was the private equity movement, was it actually heralding something profound that's going to change our life in the manner that these supercomputers, perhaps they'll be embedded in our brains, but it's difficult to imagine that we're on the cusp of another profound, dominating change.
Yeah.
So, technology,
Then if we go back to Mr. Powell, I mean, if he has to continue to raise rates like the ECB raised rates today, if he continues to somehow try and combat inflation, does he not create an incredible depression in the US economy?
He has, him and his predecessors and his global peer group are responsible for the Great Depression that no one is willing to discuss.
Yep.
And talk is cheap. And again, we'll in the show notes, we'll put up a slide by Matthew Klein. Matthew Klein's an amazing American economist. He co-authored with Michael Pettis, Trade Wars, Class Wars, and a man spoke about globalization. And he put out a chart which was to take US GDP per capita, per person, and the starting point index to 100, and we take the emergence of the US financial bankruptcy in 1930, and we take the path taken by that GDP per capita in the years thereafter, and at the same time you can put on top of that the GDP per capita index to 100 for the US starting from, let's say, this point 15 years ago. So we got 15 years of two discrete data sets. Okay, the Great Depression, the 100 has gone to 190. You can see it in the chart now. You can hear my voice, but you can see the chart. The corresponding level for us in the silent depression, we're at like somewhere between 150 and 120. You think of that. Okay. Now the retort to that might be, yeah, okay, well, but we kind of got we got the Second World War, and you got the great build-up of armaments and everything. But we had a war, and actually we had a war. We've gone through that. The pandemic was a war, and a war with an invisible kind of virus, which has brought forward, a ton of fiscal spending.
And I guess the largest debt pile since the war.
So why are we not talking about it? We live today in a depression. Now, thankfully, we've not had many. I want to say 1830. I want to say 1870 to 1890, 1930 to 1950, and now 2009 to X in the future.
So, but we haven't yet seen unemployment move.
Or I don't know. I mean,
but unless they're making the numbers up, unless it's classed differently, and the gig economy plays a much bigger part, and it's not within statistics. Yeah,
it's something's going on. The Wall Street and it's very excited about these data points. So
I guess Wall Street we have to hang our hats on something, don't we?
Yeah. So I'm seeking clarity to this. I don't wish to sound a naysayer. I think it was 10 days ago, a professor at Harvard put out, and he's a Russian follower, political scientist, and the Russian central bank, or the Russian economic authorities, reported GDP for last year, and I want to say it was reported as down 2.2%, and that has been accepted by all of the major financial institutions, both private and these public entities, IMF, etc. Did the Russian economy contract by 2.2% last year?
I'd like to think. Well, I'd imagine it contracted by a lot more.
Yeah, I think it did. What is the probability? What are the chances that that figure was not corrupted?
Mm-hmm.
And isn't 2.2 remarkably close to the political demands of Vladimir? You know, that number kind of is a bit Goldilocks. But it was accepted. So we accept things. And so I want to say that the willingness to accept this tightness in the labour market comes from a fanaticism and indeed from the fact there's only 5 people in the world that truly understand the nature of money. And therefore the Fed has been able to convince the world that it's printing money when it's not.
Yep.
And printing money creates inflation, and inflation comes from tightness in supply, and labour is the biggest price in the economy. And so everyone wants to believe it. They've wanted to believe it for the last 15 years. Believing it has been the road to ruin. It has not worked, but it hasn't stopped them wanting to believe it. And therefore that's where I'm a little bit more sober on the tightness of the labour market, and more so because Go walk amongst the real people. And I was like, hey, the labour market's amazing. You're like, life must be really good. And they're like, yeah, you're a finance type, aren't you? Like, our life sucks. Thank you very much. So there's a disconnect somewhere.
No, indeed. And I think the UK has its own issues post-Brexit and the labour market and cost of living.
Well, you say that. Yes and no. Brexit could be Trump. But actually the UK and the US are joined at the hip in that they are the principal recipients of capital flows, global capital flows. And again, this is where we live. Our world does not make sense. Economics is a car crash. I mean, nothing makes it. Globalization is a good thing. Ricardian equivalence, specialization of labor. Our lives are enhanced by the fact that China can do these things more cheaply, and therefore we can go on Amazon and our living standards go up because a lot of household items have fallen in price. I mean, when I was a kid, you lived in fear that someone would break into your house and steal the VCR, the video recorder, to get some money. No one steals we don't have video recorder, but no one steals shit like that anymore because it's not worth it. No one steals cars, No,
just watches.
What? Yeah. Well, yeah, they around here, but and not in the hoods. So, and then the thing that doesn't make sense is, okay, hold on a second, because one of the great mysteries about the UK, but also the US, is that investment levels are really low. So the citizens of these countries, the risk-taking citizens don't want to invest, and their governments don't seem to want to invest, and yet they're recipients of all this capital-seeking invest. Why are they not going to where the return on capital and the desire is higher? The system is so messed up.
Yeah, I recorded a podcast with a great UK fund manager the other day who highlighted the fact that in the 1970s, the UK pension funds equated to 55% of the London market. Currently, they own 5% of the London market.
Well, yeah. When I was a boy, when I was starting off in Edinburgh working for a pension fund manager, an esteemed pension fund manager. First of all, they were managing $3 billion. As of 18 months ago, they almost got to 300 billion. 300 billion, so 3 to 300. Yeah, we've had asset price inflation, but those boys really nailed it. But and they ran 60-40. They were a pension manager. They had a managed account. And in that 60 equity portfolio, the US allocation was 2.5%. So 2.5% of 60%. Yeah. Things change.
I mean, that would have grown, of course, and the size of the US market, and also that technology bubble that we've spoken about that we've had for the last 15 years.
Indeed.
23 years.
I mean, I can recall just beseeching people, that we had to, that the best companies, like 2.5%, so you should have 2.5% in individual US businesses. I mean, they're way better than the stuff we can find elsewhere.
So if rates are going to carry on rising, and where do you see do you have an idea on terminal rates, or is it just keeps going until more things are broken?
It doesn't matter. Terminal rates. I mean, they won't get to terminal.
Well, okay. So let's say, I mean, even at 5%,
terminal rates. Then let me tell you, the terminal rate is 0.
Fine.
Yeah.
So the risk-free rate now we sit at look, even the Fed's fund rate, let's say, so 5%. So actually, any investment, if you're sitting there, you have to do better than 5%. So obviously that puts equities into question. I mean, what happens to the bond market?
I mean, first of all, why would you expose yourself to risk assets? So in the UK, I don't even know. What is cash rates? What would the ECB raise rates today to like 2.5?
Yeah, a bit more than that, I think.
Bit more. The US was at 5. You can't invest at 5 anymore. You're investing around about 3.75. But as of like a month ago, you could have had your money in 2-year in US and earned 5%.
Yep.
I was on Bloomberg the other day. It's like, but isn't that risky? What? It's kind of risky if your terminal rate this year is 7.5. But boy, am I willing to take that risk. And then something which we haven't figured out, we haven't reflected on, is like from a UK perspective. That 5%, to put it in perspective, that could be in an unhedged dollar position, and I think you'll make money in the dollar as well. So everything else, and then you've got like just this. You've got so much ammunition if everything really comes off. I mean, believe me, I want to buy stuff.
Yeah,
indeed. So you asked about bonds, government bonds. Oh my God, I love long dated. Why do I love long dated government bonds, US government bonds? I love it because owing to the duration, there's an implicit leverage, like the price response is way greater. The amount of 2-year or cash money that you'd have to own to replicate that via leverage wouldn't be feasible for the regular Joe with his SIP or with his investment product. It would be available via an ISDA for a hedge fund.
Yep.
And why do I like that? If we look at the tilts, the TLT, the iShares, the ultra long treasury, so it's kind of duration greater than 17 years. It was subject to the most profound mean reversion. 18 months ago, it traded at 180, and before our dear friends in Silicon Valley blew up, it was trading like 95. So it halved.
Yeah.
It was trading 15-20% below the 20-year moving average. So let's do something silly and say that you'd received no income or ignore the income from those treasuries. You've actually lost about 15 to 20% over the last 20 years owning treasuries. Now, you haven't lost because you've been compensated by a carry, but your return now has been reset almost to zero. And again, remember what I said to you earlier. The last 15 years, the progress in US GDP per capita is dramatically trailing what was experienced during the Great Depression.
Yeah.
This is preposterous. This is an opportunity. So for me, government bonds, is particularly the American variety, represent where the S&P was in March 2009. You didn't want to buy it, but you had to buy it.
Yeah.
And then finally, I want to say, remember I was saying to you, these capital flows coming into the US and the UK, and they principally come from these large continental countries, China, Asia, most of Europe, that play a beggar thy neighbor game of persistently producing trade surpluses. And that comes from taking potential demand out of their economies, transferring kind of wealth from their household sectors to the centre, and then transferring it into the US and the UK as a means of controlling currency, again, to deliver economics again is not meant to deliver persistent trade surpluses. Something is going wrong with the system when that happens. But those persistent trade surpluses and their capital flows are the mechanism which which transform mean reversion into the most amazing profit opportunities.
No, I get that. Speaking of mean reversion, last time you were on, we had an interesting conversation about crypto, and you said there would be a time to buy. And I know that you've been quite vocal on Grayscale.
Yeah.
What's your thought there?
So Grayscale is filthy in terms of, I have to be very careful with the adjectives I use. I am no great advocate of those promoting that scheme.
Yeah.
Why? Because they charge a 2%.
Who in God's name would charge 2% of AUM?
Which is for a passive strategy. Now, that everything has context, and they were afforded that great rent because it was desperately difficult for institutions to gain exposure to Bitcoin, and Bitcoin was surging in value, in price. Value, I don't know, but in price. And therefore, they were one of the only means to get it. And such was the clamour for that exposure, the greed, if you will, that it's an investment trust, or in the US vernacular, it's a closed-end fund. And it would trade at a lofty premium, more like 40%.
Yeah.
And
actually, that's sort of a scarcity premium, isn't it?
Because, scarcity. But then it became very reflexive because there's a labeling of, what is the labeling? Let's call it, the labeling is not professional investor, but let's call it a professional investor.
Yeah.
You could go to the trust, and you could ask them to issue new stock, and they would vest in you. They would effectively you transfer your funds. They would buy Bitcoin, and in 6 months' time, you would then receive the stock.
So that's a little bit like the Sprott Uranium Trust.
Probably,
you have a sort of open tap.
Well, yeah. But what that means was you were buying Grayscale at NAV when it was trading at 40% premium.
Yeah.
And that was just, that's where I've had interviews with Kyle Davies from the Broken 3 Arrows Fund. And, all my friends were playing this game, but you were very cautious with how much you would feed the beast. And Kyle and his gang came in, and they just went so super crazy. And the NAV, so the holdings in Bitcoin for Grayscale, I think at the peak reached 70 billion, 60 billion. And remember, the problem was, it was like a snake swallowing an elephant. There was a 20 billion lump from Kyle and gang. Okay. And we all knew in 6 months' time that would be put onto the market to capture the arbitrage.
Yeah.
And at the same time, we saw that there was a Canadian ETF launched. There was the futures launched in the States.
Yeah.
The scarcity in terms of the means of gaining exposure, there was no scarcity. Okay.
Yeah.
So who was going to buy the 20,
Yeah.
And so what we've seen, of course, is that rather than trading at a 40% premium to NAV, it trades at a 40% discount. And we've seen the best part of an 80% contraction in the underlying asset, namely Bitcoin, Ethereum, etc. So today, again, I'm desperately eager to buy things. Why am I desperately eager to buy things? Because I've made just about every mistake. If you live long enough, you just about make every mistake. If you're still alive, Nassim Taleb and the paradox that it's the 55-year-old Italian gent that is awarded life assurance when we invented life assurance.
The smoker.
Yeah. Not the 21-year-old kid.
Yeah.
And first brush is like, but that makes no sense. It makes a lot of sense because he survived everything that a really tough life could throw at him. And so that was going on. And I did not buy the S&P in March. I executed very well in 2008.
Yes.
I wouldn't be talking to you mere mortals if I had bought that S&P in March 2009. I don't know where I'd be. But I didn't. But anyway, so today, Grayscale, you can buy an asset which has profoundly mean reverted and which is trading at a 40% discount to NAV. And if you just mention the name on the Twitter sphere, like, people just get so angry. They're just not interested.
But that's where the opportunity lies.
That's where the opportunity is. But don't get me wrong. In the world that I fear that we're going into, that the the bond curves are telling us, the hedging is telling us. Well, it's a market with like grayscale. The underlying unit probably could fall 50% again. I mean, Bitcoin could fall 50%.
So let's talk about that sort of future. It would seem we're in a tricky time for financial markets. What is the catalyst of that changing? Well, if we were to have your crystal ball and look 6 to 18 months in advance, what do we need to look at? What are the triggers to get through this?
Triggers, do you mean in terms of what else goes wrong before the central banks?
Yeah, both actually. Let's do that. So let's do what else goes wrong, and then how do we see it being repaired?
So we get more failures. The status quo of 18 months ago was sustainable. What do I mean by that? 18 months ago, Apple was a $3 trillion company, and that was sustainable. Implicitly, large investors, they're smart, and they were weighing up the fact that we seem to be in a depression, a very risky operating and commercially very risky environment. And with Apple, they were saying they were willing. Such was their expectation that Apple could evade a lot of the commercial risk. And I think that's true. That they were effectively willing to lose money in Apple. And their judgment would be that they would lose a lot, but almost certainly over, let's say, a 10-year holding period, most likely they would lose money. But the loss there would compare very favorably with the losses perhaps recorded elsewhere in the economy by businesses with more commercial risk.
Yeah.
Okay. That was a sustainable set of circumstances as long as the carry was kept preciously low. We live in a world where the real rates up until the great financial crisis were so fantastically large and rewarding to the creditor community that's kind of why we had the housing. When we had this, what did we call it? Ninja lending. I have no ink. Let's be proportionate. I just got divorced. I'm a drug dealer. I'm just out of prison. And the bank's like, do you want the money or do you not want the money? The creditors wanted to avail you of the credit because the return to the creditor community was so high. Okay. Now we're at a point where in a depression you have to reverse the rewards and you've got to push that to the debtors. And I think that means we need negative real interest rates. And I think really that was the purpose of quantitative easing, to create negative real rates, which put a rent on the creditor class, and actually you create an income for the people who are going to revolutionize the future, and indeed consumers, and how we've got this deficit of potential demand, and how we solve that. A long way of saying that we created a construct which could only survive with a carry of zero, nominal carry of pretty much zero, and a negative carry in real terms. That's the financial repression, and we would need decades of that, and we would right the ship, and I still believe that's the case. And then we had the Fed folly.
Yep.
So the Fed folly breaks things. We have commercial property. So Silicon Valley crisis was always imminent. They're unmarked, marked to loss, or whatever that term would be, versus equity. They had no equity.
Yeah.
But it was a fragile but sustainable equilibrium as long as the deposit base was fine, and then it wasn't, and therefore they had to mark. And you have that commercial property is fine unless there's a liquidity moment, and properties do hit the market, and therefore there's the revelation.
Well, there's a clearing price.
There's a clearing, and it's truth-seeking markets. Yeah. I get with the Silicon Valley et al. Funding. So the funding from the VC guys has come to a halt.
Yeah.
The life support from the bank now is over. I don't think HSBC is going to be extending its credit to that space.
So we will see a collapse in startups and technology firms
I
because
fear
we just
so.
won't be able to get the funding.
I fear so. But the knock-on for that will be the need to have greater clarity and truth in the mark-to-markets for these enormous venturist funds. And that's a lot of GDP we've just discussed. We've discussed commercial property, the VC world,
The private equity world.
Then I mean, I can't quite quantify it, but we've been discussing, it started in Japan, but we know it exists within our fold in the UK and elsewhere, the zombie companies. Mm-hmm. Zombie companies, again, were sustainable as long as the carry was zero. Yeah. The carry's 5, the ECB's raised rates, probably the Fed will raise rates again. Yeah. We're breaking things. So the steps ahead is just the witnessing of things breaking. And a liquidity event will force the hand of a Federal Reserve that doesn't want to cut rates. It will cut rates. Now, there's wider implications. And again, we come back to globalization, and we come back to this. I'm very mindful. I'd listen to a podcast, and I'd give it. I paid $70 to subscribe to a podcast.
Grants?
No. Michael Pettis and Matthew Klein. I find they have genius. And the speculation, and Ray Dalio talks about this as well, it's funny, he talks about with a cadence of 70 years, give or take 25.
Yeah.
Give or take 25 years is quite a wide variance, but I'm sympathetic to it, where the whole system needs to be, the monetary system has to be re-engineered, and I think we're getting closer to that. So the re-engineering of the monetary system, of the fiat monetary system, if I take the Pettis and Klein view, is that the US and the UK have to emulate what Europe, and more specifically what China does, which is to discourage capital flows into their community. Because those capital flows have effectively destroyed entrepreneurship and capitalism, and they've turned their citizens into speculators, because the only thing has been rising asset prices. And rising asset prices over the last 10 years now embody a lot of fictional wealth. Mm-hmm. But now fictional wealth is not motivated by avarice, not motivated by trying to pull the wool over people's heads. We introduced a lot of debt to GDP. It's gone up, and that exaggerates the potential of GDP growth, and that exaggeration creates mark-to-markets which are too high, and that gets unwound. So essentially the US and the dollar have to volunteer, have to get, there's got to be a kind of a sovereign heads of government type thing. They've got to kind of work out, I hate Bretton Woods. I think Bretton Woods was nothing. Bretton Woods simply was something proposed, didn't really work. Private sector worked it out and created the euro-dollar system. Mm-hmm. Euro-dollar system is in retreat, which is why I'm very fearful. It's why I was very fearful of the Fed. The Fed do not measure the creation of US dollars out with the sovereign state of America. They seem not disinterested. And I think that in terms of the quantum of new dollars created offshore versus onshore and within the domain of the Federal Reserve, I think it's like 2 or 3x offshore what it is. And so now we know that onshore money supply is contracting, and offshore, I think it's been contracting for 2 years. Again, that's why I'm fearful. That means there's a profound shortage of dollars. That means the dollar's going to go rocketing higher and higher. And then ultimately, I think the heads of state is all about how we bring the dollar down. And that's done by discouraging speculative capital flows into the US and the UK.
Yep.
I think.
Interesting. What sort of timeline? How does that actually play out?
It's the Hemingway. Is it Hemingway? It's the bankruptcy thing. Slow, quick, and we've just introduced one Q-tip. We've just gone quick, and I think there's quick.
So look, it's very, very interesting times. Then I mean, I guess we all look out for further collapses and more issues and breaks within our financial environment.
Well, indeed, but that's, anyone listening going, God, I've listened to all this bearish nonsense for 15 years, and where would that have got me?
Well, not that bearish. I mean, last time you didn't want to buy anything, and now you're thinking about buying things. So I think that's a 180 degree turn.
I'm long that TLT at 95, and if we get a 50-60% from the highs in the S&P, oh my God, I'd be buying it.
Yeah.
I'm buying. I mean, when I say I'm buying, I'm intellectually buying. I'm going to take a big comeuppance with my real estate investments in St. Bart's. Now, again, I try to get myself out of some danger in that I believe
by offsetting some of the risk.
Simply that domain I will see hostage to fortune, but I don't believe it's leveraged.
Yeah.
There are only three French banks who will lend you against the collateral of land there, and mostly transactions are done via disposals elsewhere and equity. We'll see, but I think we've definitely seen the high mark on those properties for some time. But yeah, I would have some grayscale. I definitely want to buy, again, more liquidity events. I definitely want to buy that. So I'm buying Bitcoin with it. Basically, I'm buying Bitcoin with a 40% discount.
Yeah,
I would do that.
Yeah.
I'm buying treasuries, which are trading on the 20-year price moving average. And I'm seeing if the S&P were to trade there, I would do the same. And if there's a puke in gold and gold mining stocks of that magnitude,
you buy them back.
Now I can buy them back.
Yeah. That looks super interesting. Now, last time you very kindly answered my normal closing questions, but I thought what I would sort of comment on today is that we are working, that's the Acid Capitalist and the Different Perspective podcast, on a live summer collab, which obviously I'm very excited about, where you and I and another guest will talk in front of a live audience in London, of which the audience will be able to participate and ask questions. So, and we're just sorting out the date, but I'm very excited by that.
I think the other guests should be very fearful, because there is this saying in finance that, in Hollywood they say never share a stage with pets and kids. Yeah. In finance they say never share a stage with that idiot at the Acid Capitalist.
No, that's certainly not the case. Look, Hugh, this has been absolutely mega. Happy birthday. Enjoy the celebration tonight, and very much look forward to seeing you again soon.
Thank you. There you go. So we're back. Acid Capitalist show recorded in this week of great excitement, great turmoil. What happens next? I hope you can join in again. I hope I will be functioning after my birthday entertainment this evening. I hope my brain will have the faculties to take on perhaps an interesting guest, and we will dissect what's happened next week. Thank you for tuning in. Remember, ratings, comments, follow us. We need the tribe. Thank you very much. Take care out there.